Hi, and welcome to this session on ratios, risks, and internal controls. We'll be looking at three things: key ratios to measure your credit union's performance, risk management, and effective internal controls. You'll see that they go hand in hand in contributing to your credit union's success. So let's get started. Ratio analysis is simply comparing different ratios to measure your credit union's performance and over time determining whether the performance is as you expected or whether strategic decisions are needed to improve in your credit union's operation. So what kind of ratios are we talking about? Well, regulators look at a set of financial measures that are key indicators of your credit union's financial health. One of these key ratios, and the big one we'll talk about today, is the CAMEL ratios. It's actually a series of components backed by ratios that you'll find most critical to measuring your performance. C stands for capital adequacy, and you'll find this using the capital ratio. The capital ratio indicates how much capital is available to cover any claims you may have on your assets in the event of both unexpected and expected losses. This is your safety net. It tells you how much you've accumulated in earnings since your credit union began, and we measure that against the total assets of the credit union. The capital adequacy ratio is determined by taking statutory reserves plus any capital reserves plus undivided earnings divided by total assets. The goal of this ratio is to help you determine how much capital is enough. The NCUA's capitalization chart goes all the way from critically undercapitalized to well-capitalized. Primarily, credit unions strive to be adequately capitalized or better, hence the term capital adequacy. A stands for asset quality. To find your asset quality, you use the net charge-off ratio. It's basically a delinquency ratio that compares the total of delinquent loans divided by total loans outstanding. It's kind of a measure of how effective your charge-off process is, whether the loans can be collected later or if you're not charging them off soon enough. Another ratio related to net charge-off would be recovery ratio. This recovery ratio provides a percentage of previously charged off values that are actually recovered. If your recovery ratio is high, there's a strong possibility that you're too aggressive in your charge-offs, and you may need to work with members a little bit more before you make the actual charge-off decision. In the end, you'll improve your overall asset quality. M actually doesn't stand for a ratio, but rather for management. You see, a credit union's management team plays a crucial role in overseeing each one of these ratios. Management should develop a sound strategic plan identifying possible risks, and it should be approved by the board. In addition to earnings and financial risks, technology plays an integral part of this strategic plan. Other items that encompass management include internal controls, risk management, and compliance. Comprehensive management practices with oversight from the board is critical to the success of the credit union. E stands for earnings. In the earnings category, one important ratio is the return on average assets. This is a standard measurement of profitability and allows you to compare your credit union to other similar asset-sized credit unions. In other words, it paints a picture of how effectively your credit union is using assets and liabilities. And this one is especially important to note because although your capital can carry you through some lean times, regulators will watch a consistent management of the credit union's balance sheet in order to produce stable earnings. That's why you always want to keep track of your return on assets using this ratio. A second earnings ratio of note would be your operating expense ratio. This compares your expenses relative to your credit union's asset size. It gives you an idea of how efficient your organization is in serving your membership. To find the operating expense ratio, you simply divide operating expenses by average total assets. It's better to use your average assets versus month-end assets in the calculation because many credit unions see fluctuating balances throughout the year. Using the average balance will give you a truer picture of your entire operations for the year versus just 1 month at a time. Finally, we have L, which stands for liquidity. One of the key measures for liquidity is the loan-to-share ratio, and this measures the degree to which the member savings are funding member loans. If you have a high ratio, it shows the credit union has been successful in providing loans to their membership. However, if the ratio gets too high, the credit union will need to make sure they are aware that they may have a possible liquidity problem if heavy withdrawals occur in the future. On the other hand, A low ratio may result from high interest rates on loans or restrictive borrowing. The formula for this ratio is very simple: outstanding loans divided by total member shares. Now that we've heard about some of the big ratios your credit union will need to utilize for measuring performance, what are the next steps? And what do you do with that information? Well, many credit unions will have a ratio review section within their monthly board packet, which will show changes in values of those ratios over time. Whether that change is positive or negative for your credit union will determine your performance. Now that we've discussed ratios that pertain to your performance, let's talk about another area of performance to your success: risk management. By having an understanding of risk management fundamentals, you'll be able to make sound decisions to protect your credit union from loss. According to the NCUA, credit unions should be aware of 7 risk areas. The first is strategic risk. This is risk of adverse business decisions through management or board's actions or inactions. If strategic risk is properly addressed, the rest of the risk area should flow pretty well. Monitoring and changing your strategies are all part of this process. Credit risk is the second. This is the risk that credit unions won't be able to recover money from a loan or investment. Some causes of credit risks include poor underwriting policies, quality of borrowers, types of loans you make, quality of investments, or the strength of the issuer. It could also be impacted by a recession, war, or pandemic. It could also be industry-specific or sponsor-related. All of these things should be considered when making credit decisions. Third is interest rate risk, or the risk of loss due to rising or falling interest rates. If rates change, what happens to the net interest margin of your credit union? How does it affect capital? Fluctuation of interest rates could pose a risk to your credit union's loan and investment portfolios because of the impact of fixed-rate loans and investments, commercial or adjustable rate mortgages with ceilings or floors, and even risk-based pricing strategies. Interest rate risk should be addressed in your business planning and policies. Number 4 is liquidity risk. Liquidity risk is the risk that you will not have adequate cash available to fund loans, meet withdrawal demands, or pay your credit union's bills. The real challenge is how much is enough, and how much do you really need? Where can more cash be found in the case of an emergency? What sources can be borrowed from? Is borrowing from the corporate an option? Can investments be sold? These are all questions to ask when it comes to liquidity risk. To combat liquidity risk, establish advanced lines of credit, understand the value of your investment portfolio, and know which pieces of your loan and/or investment portfolio you could sell or participate out quickly to gain the liquidity you may need throughout the course of your operation. The fifth risk is transaction risk. This is the risk of fraud or operational problems in transaction processing. It could result in an inability to deliver your products, remain competitive, or manage information. This is an area where having strong internal controls, which we will address shortly, will be critical to your success. Transaction risk requires that credit unions pay special attention to audit comments or any feedback that you may receive internally from your risk team. You may also want to consider a staff fraud hotline in the event that a staff member identifies a transaction that seems unethical and wants to remain anonymous. Next, we have compliance risk. This is the risk of violation or noncompliance with applicable laws and regulations that may result in fines, penalties, or damages. Be sure your credit union has a process in place to inform your staff of new regulations, as well as address and test regulations regularly. It's also important to mention that compliance risk seems to be more and more of a focus on regulatory exams in recent years. The seventh and final area of risk is reputation risk. This is the risk of negative public opinion or perception leading to a loss of confidence and potentially even a loss of relationships with credit union members and vendors. So, how do we deal with these risks and address the ratios that show our performance? The answer is internal controls. Internal controls are simply part of a system that ensures the accuracy of your records, guards your assets, and makes for efficient operations. At the end of the day, management and staff are reliant on information that is proper, adequate, and correct. The best way to get that accurate information is to have a system in place that follows policy, has sound procedures, and is validated and reviewed by outside sources of the supervisory committee. Strong controls also inhibit staff members from even considering crimes such as embezzlement. Therefore, a strong financial reporting system backed by internal controls is a must in every credit union. Now, let's talk about what types of internal controls credit unions should implement. One is limiting access to cash. The board authorizes management to maintain cash to serve the members. This may include ATMs, petty cash, vault drawers, and teller drawers. Another is segregation of duties. When 2 or more people are involved in a transaction, it safeguards the people involved, and it can act as a form of checks and balances. You wouldn't want the same person issuing and signing checks, for example. You want to share responsibilities across the organization when possible. The final internal control we will discuss is effective personnel policies. Does your credit union perform background and reference checks on all potential new hires? Do you require annual vacations for all employees? These are just some of the personal policies you can implement as an internal control. And there you have it, ratios, risks, and internal controls. All of these things play an important role in ensuring your credit union's success and should be top of mind when making decisions. Thanks for joining us.